Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. It's going to be an action-packed week with four major upcoming central bank meetings. We have got the rate decision from the US, Japan, UK, and Australia. Good morning, JK. A lot of events this week. Take our listeners through what's important.
Good morning, Swaraj. There are actually five major central bank meetings this week. Swiss National Bank is also there this week, which comes right after the uh, US Fed. Now, what's likely in the coming meetings is that in the first meeting is by Bank of Japan tomorrow, and there have been several reports in some of the media that they are preparing to change the monetary policy from negative interest rate policy. They might as well push it to 0.1%. But so far, the market reaction does not show that they have the conviction about the Bank of Japan changing the policy, because yen has since been weakened above 149. We also had Bank of Japan announcing an unscheduled bond purchase program today of $20 billion US, which is keeping the market actually very cautious, because Bank of Japan generally does not meet the market's expectations. So that's one part. Then Fed, we have a good chance that they change the dot plot from 3 rate cuts this year to 2 rate cuts based on their own, estimate of earlier estimate of inflation not being met and inflation remaining sticky around 3%. We have been, informing you about the developments on the inflation front in the CPI and PPI last week. All that plus the PCE number also, which was higher, keeps the Fed cautious about moving early. So there may be a few members who want to shift their dot plot, into 2 cuts this year rather than 3 cuts, and that's what the market is also looking forward to. But is the market prepared for it? Yes, I think they are prepared for it, because there have been several statements from Fed members and also the data. But overall, if you see, the reaction for the market should not be too much for this, because one, they are prepared for it, and the other is, apart from inflation, which shows stickiness around 3% plus, we have the economic data from US, which is not really that encouraging, actually showing some weakness. Manufacturing numbers on Friday, both on the industrial production and also on the Empire State Manufacturing, all of that, they didn't show a very strong picture. In fact, there was some weakness in the industrial production data. We also had the consumer sentiment data, Michigan survey, which showed lower number. In fact, inflation expectations from the consumers have also been slightly lower. More importantly, the regional Fed surveys, like the New York Fed, which is whose GDP estimates are more relied upon by the analysts, is now down to 1.8% from 3.3%, and Atlanta's GDP forecast is down to 2.3% from 2.5%. So I think Fed, while they may actually change the dot plot, they will not say anything very hawkish. They will say economy requires to be addressed with the rates according to data that is evolving, meaning a data dependent approach. Then we have the Bank of England meeting on Thursday. There, of course, there has been some lowering of inflation expectations in UK, but that may not be enough for Bank of England to push forward their interest rate cuts. They most likely they are going to do it only in the second half of this year. Again, a data dependent approach. Swiss National Bank is probably the closest to a rate cut, because their CPI has been falling much closer to their target, and they might be the one to take a lead. But again, the expectations are not so clear. So there may be some suspense around the Swiss National Bank. Of course, sorry for the error on my part. The first meeting will be from Reserve Bank of Australia tomorrow at 10 a.m. This will be much before the Bank of Japan meeting, and I think RBA is very likely to keep a data dependent approach, unlikely to change their policy rate at all. So all in all, as you said, we are waiting for these policy decisions, and markets should remain in a holding pattern. On Friday, we had a little bit more move up in the yields, nothing to prompt those moves. 2-year and 10-year, both of them moved up a bit, with the rate cut chances in June dropping to around 57% now. from very high levels of 85% that we had seen a few weeks back. That and the continued supply of long-term paper from the Treasury also prompting the major indices in the US VIX registered declines for the week, and this was after 7 straight weeks of gains for these indices. So that's again a technical move in the market. Not much to read from it. As far as the dollar is concerned, some currencies have displayed some weakness, like yen went above 149, and we had the Canadian dollar, which went again to its resistance closer to 1.36, but the euro has been holding around 1.0880, not far from the recent high that it has seen. So I don't think currencies are looking very overbought against the dollar, such that they are already prepared for Fed changing the rate clause, unless Fed talks hawkish beyond the dot change. I don't think currencies are likely to fall much from these levels, or any hint of dovishness may actually lead to currencies recovering much more. I think these conditions have also added to gold correcting itself, which is a much needed correction in the gold, which was required. Coming to the Indian side, the important number was the trade data that came on Friday. It showed goods deficit actually rising slightly to 18.71 billion versus the previous number, which was around 17.5 billion, and this was due to a higher increase in the imports. But overall deficit has come down because of the increase in the services exports. Net services exports have been rising for several months now. If you look at the Indian external macro picture, we are very comfortable in the sense that currently estimate of India's current account deficit is closer to 1%, which is around $35 to $40 billion. We already have had in this financial year more than 40 billion of FPI flows. FDI flows can touch around 20 billion at least on a very, very conservative basis, which means that we are going to be in a very healthy BOP surplus. No concerns on the rupee because of the external front. Only threats can come if there is a global major risk of event, or if the oil price, which has recovered significantly in the recent weeks, if it crosses 90 and starts moving to 100, those are challenges that rupee can face. Otherwise, at least till end of this month, I think we will be stuck in 80 to 60 and 83 range. Central bank is expected to be active on both the extremes, and of course, exporters will be keen at higher levels to hedge themselves. So all in all, not expecting too much movement till Fed decision, but yeah, I think it's an important week from a policy perspective. Thank you.
Thank you, JK. And just quickly summarizing, as you mentioned, five major central bank meetings this week. RBA, which is the Reserve Bank of Australia, is likely to keep things data dependent. Bank of Japan, now this is interesting. They are preparing to change the policy from negative interest rate to something more positive. But the reports are mixed on whether they will be going ahead with it this week. So that's something to keep an eye out for. Fed, there is a possible change in dot plot from 3 rate cuts to 2 rate cuts as inflation remains sticky. Even economy of the US has been showing a weak picture as per recent data on industrial production and consumer confidence. And even Bank of England is expected to keep things data dependent. For India, we saw a marginally higher trade deficit, goods trade deficit rising to 18.7 billion. But net services exports has been rising, keeping the current account deficit in check. Other than that, there are a lot of capital flows, FDI, FPI, which should keep the BOP pretty healthy. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.